Okay, everyone, thank you for waiting and welcome to another one of Option Hotline's free trading webinars. Thanks for reading through that disclosure briefly. My name is Natalie and I'm going to be your moderator this afternoon. We are happy to host Dr. Duke. He is going to be talking with you all about throwing away your crystal ball, give up forecasting the market, and just trade what the market gives you. That sounds pretty great, to be honest. Dr. Duke is the founder of Parkwood Capital, which is a business consisting of stock and options coaching, a weekly newsletter, and 3 different trading alert services. He has over 30 years of experience trading in the markets and has been doing so since 1999. He's got a formal finance training with his graduate level business degree, as well as advanced options training at the CBOE Options Institute. He is a frequent speaker at all sorts of trading presentations all over the country, and he also often speaks on behalf of different brokerage firms as well. We are very happy to have him here this afternoon. Dr. Duke, are you with us?
I am.
Hi, thank you for being here today. We're all excited to listen to today's presentation.
It's my pleasure. Thank you.
Wonderful. So while Duke is going to go ahead and share his screen and pull up his presentation, I just want to remind everyone watching and listening that if you have questions, please type them in the chat box or the Q&A box, and we'll get those over to Duke to be answered at the end of his presentation. Duke, I can see your screen. It looks great. So whenever you are ready, take it away.
Great. Thank you, Natalie. And thank all of you for joining us today. I appreciate that, and I'll try and make it worth your while. What I'm going to talk about is a different type of trading. Normally, when we talk about trading, we're automatically thinking about which way is it going to go. We think about Bitcoins, for example. It seems to be the hot new topic. We obviously buy Bitcoins when we think it's going up, and we sell them when we think it's going down. And that's true regardless of whether you're buying commodities, could be currency trades, could be a variety of things, stocks, options. It's normally thought of as a directional trade, but options are somewhat unique, and you can set up delta neutral trades. And what that means basically is you're setting up a trade that has a minimal dependence on the underlying stock price, or at least a range of stock price that you still profit under. And of course, there's a couple of different things about options though that you have to keep in mind. Stock traders are often surprised by 2 different effects that they're not used to. The first one is implied volatility, a concept that doesn't exist in stock trading. And implied volatility simply means that the price of the option depends largely on the supply and demand in the marketplace. In other words, do people want to buy this option? Is it really exciting, I guess you might say, or they think they're going to profit, so they're buying that particular option. And that can change in your favor or against you. It goes both ways. And time decay is the other change. When we buy a stock, I think Apple's going up, so I buy Apple stock. Well, that's fine. I might watch it, and for, say, a month later, I come back and look at it, and it hadn't changed at all. Well, if I bought the stock, I'm not really too concerned. I may revisit my analysis and say, well, I think it's still a good trade, and you stay with it. Well, if you bought the call option, it's quite a different story. You see to your surprise that even though the stock price hasn't changed, my call option is worth a lot less because of the effect of time passing. That's time decay. And so those are 2 concepts that we have to keep in mind when we're trading options. Now I've put the risk reward curves for 5 common delta neutral option strategies on the screen. Now these are kind of tiny, but let me just kind of generally go over it. For each one of these, this tall vertical line, the blue line in the middle, is the price of the stock right now. This black line across the top, the horizontal line, is the 0 between profit and loss. It's profitable above that line. It's a loser below that line. And so for each one of these, you see that there's a pretty broad range of the stock price, this stock price along the bottom, where it's profitable. Same thing here, then here with a calendar spread, here with our double calendar, and here with our double diagonal. And so the point of this is just to show you that these trades give you a little bit of freedom in terms of the passage or the movement of the stock price. But the passage of time is actually what makes the money for you. And so our advantages are simply that wide range of profitability and the fact that the stock price can move around within a certain range and we don't care. And these are all what we would call high probability trades. They typically have probabilities of anywhere from 75 to even 90%. And the time is really working for you. You can think of it this way. You're basically selling an option. And the fact that that option is losing value as it gets closer and closer to expiration is in your favor because you sold it. Now you can buy it back for a lot less money. The disadvantages, though, are rooted in this fact that we have the probabilities on our side. Namely, we may have a very large probability of a relatively small gain, but we also have a relatively large loss that's potentially there. It's just that it has a low probability of occurrence. And so we can never lose track of that. That's critical. And that's why the most important thing about delta neutral trading is risk management. You have to manage these trades carefully. You can't just put these on and assume I can just let the probabilities run. I've even heard people that should know better say things like that. Just put on a trade and let the probabilities run. They're in your favor. Well, that will not end well. Here's a plot of the time value in a typical option over time to expiration. So as you can see, when you're out here 60 days or more from expiration, the time decay each day is pretty small. You don't notice it too much. This is especially true if you're buying a leaps call or a leaps put that's maybe a year or two out in time. But as you get closer and closer to expiration, it's an exponential curve. And so each day it gets larger. It's not linear. And that's the profit engine, if you will, that's behind delta neutral trades. Now here's an example just looking at a credit spread, an out of the money credit spread, where we sell, let's say, sell a put spread down below the price of the stock or sell a call spread way up above the price. In any case, you're selling at one standard deviation out of the money. This is the probability distribution. That means that for these prices all the way down, you profit. And that's 84% of the probabilities. So that's the kind of trade you're using as your building block to build these delta neutral trades. So generally speaking, they're high probability trades. But the dark side, as I mentioned before, is that as that risk reward ratio gets larger, as your probability of success gets larger, and as that happens, you've got a big loss looming out there. It may have a small percentage. Let's say you put on a 90% trade. You've only got a 10% probability of losing, but it's a big loss. It'll wipe out maybe 6 months of your trades, of profitable trades. So you have to pay attention to that. If you don't, most likely those losses will wipe out your gains. So that's why I emphasize that risk management is crucial. This is a powerful way to trade, but it isn't done lightly. So what's involved in risk management? What do we mean by that? Well, first of all, you need what I call a trading system. In other words, a series of rules that tell you when to get into the trade, when to get out. Just as importantly, maybe more importantly, your rules also are telling you what are you going to do when it moves against you? How are you going to adjust this trade? And I specified written for a reason. I find that unless you have a lot of experience, you really should write down your rules and keep them in front of you. Don't find yourself saying, well, I said I was going to get out at $25 and now it's $24. Well, that's close. Maybe I'll give it another day. No, no, no. That's the prescription for disaster. Write down your rules, know why you're going to adjust it, when you're going to adjust it, know when you're going to close it out altogether. If you've got some kind of adjustment method, make sure you know, when am I going to trigger that? And your methods, there's a lot of different ways to adjust all of these trades. So you need to know how you're going to adjust your trade and when you're going to do it. The worst thing you can do with really any kind of trading is to set up that trade and then be sitting there flat-footed, not sure what you're going to do when the market moves against you. That's a prescription for a disaster. So what we have here are two schools of thought. The one is the normal one that we think about all the time, take for granted, directional trading. Now, I may have all kinds of indicators. In fact, as you well know, you can have entire books written just on technical indicators. MACD, just some combination of moving averages. Even somebody arguing they should be exponential moving averages versus simple moving averages. Stochastics, there's all kinds of things. Some indicators that focus on volume, some that focus on relative strength. But in any case, you are using those, and the delta neutral trade is just one of your trades. If you go through all these technical indicators and decide this stock's just going to trade sideways, well, you don't say, well, I can't make any money in that. No, you realize that you have a tool in your toolbox, a delta neutral trade that can profit under that circumstance. And so you use, I have said in this case, an at-the-money butterfly, but you could use any one of those ones that we mentioned earlier. Now, on the other hand, when you're trading non-directionally, the discipline here is to make sure that you do exactly this. You trade what the market gives you today, not what you think it's going to do. That is a very important distinction, and it's one that's hard to get yourself to believe in and use. But the important thing of that is you have to know, how are you going to adjust this trade? You could say, I'm going to use an at-the-money butterfly, but you need to know, what is my risk management system? How will I adjust it? Maybe very simple. It may be that you have two prices on either side of this butterfly, and if it hits that price, you close it. Could be that simple. Doesn't have to be complicated, but you need to have a management system so that you minimize the losses. Now, I'll give you some examples. This is how I'm describing here is an at-the-money iron butterfly. Now, when you put on a butterfly spread, you simply sell two calls or two puts right at the money. And then you move up and buy another option, move down and buy another option. And the distance up and the distance down is the same. So you could build that all with calls or all with puts, and that's a normal butterfly spread. You can build an iron butterfly by selling a call at the money and a put at the money, and then moving up to sell one call and moving down to buy another call. So that way you have a iron butterfly. I said buy, didn't I? Yeah, move up and buy the call, move down, buy that put. So you've sold a call and a put at the money. So this is an iron butterfly, so it's put on for net credit. But both of these spreads, whether it's an at-the-money iron butterfly or an at-the-money butterfly spread, one is a credit spread, one is a debit spread, but they both have an identical risk-reward curve that we saw earlier in the slides. As you make those wings wider, as you go farther out with those wing options, the credit goes up for iron butterfly, and the range of profitability is getting wider and wider, but your maximum loss is also getting bigger. And usually almost all these trades are put on about 30 days to expiration, simply to take advantage of that decaying time decay, the decaying curve. Now here's an example of an iron butterfly trading system. First of all, you're putting it on at about 30 days. Secondly, you calculate one standard deviation. Sigma is the Greek letter that we normally use to signify one standard deviation. And so we sell that one call and that one put at the same strike price, but then buy our two call and put options out one standard deviation. Then what do we do in terms of making this thing truly delta neutral? Because the prices of the options may not be optimal relative to each other, you may find that your position isn't quite delta neutral. And so you could buy an extra call or an extra put to bring it in so that it's truly delta neutral. And in this case, I have a very simple rule. I simply close the trade when I'm down 25%. And if I get to the Friday before expiration week, I close it out altogether. Just that simple. Now, there's a lot of different ways to trade it. I'm not saying this is the best way. I'm just trying to give you an idea of what it means to have a trading system. Now, the iron condor is another one that's very popular. You hear a lot of people talk about the condor. And basically what you're doing is you're selling a call spread up above the stock price or the index price, and you're selling a put spread down below that stock or index price. Just that simple. If you're using $10 spreads, then you've got a $1,000 margin requirement. Now, immediately you see one of the advantages. Your broker gives you a $1,000 margin requirement, even though you have two spreads here. His thinking is, or the theory is, well, you can only lose on one side or the other of this. So therefore, the margin requirement is just the maximum loss on one side. So that's an advantage over, for example, a double diagonal spread, which margins both sides. Now, as you move those spreads farther out, you get a higher and higher probability of success. But the credit's getting smaller. It's like everything else in life. If you have a large probability of success, then you're probably not going to make much money. You buy a treasury bill and maybe you're only going to make 1%, but your probability of success is very high. You buy a lottery ticket and it doesn't cost you much of anything. Buy it for $1, but your probability of success is minimal. And that's the way life works. And that's the way trading works. Even though a lot of people will try and convince you that they have a high probability trade that has low risk. Well, that's nonsense, of course. But unfortunately, sometimes we get taken in by those kind of comments. That's why it's very important to understand the probabilities that are driving your option prices and therefore your option trades. Because then it's more likely that you won't get deceived by the pitchmen, so to speak. Now here's a possibility for an iron condor trading system. Start at about 50 days to expiration. Position your spreads out 1 standard deviation. And then how do you manage it? You track it. And this is what I call the 200% rule. It's very simple, but very powerful. You just simply track your position every day. Whenever the debit to close one of the spreads, let's say the market has moved up against your call spread. So the debit to close the call spread is now double the original credit I received when I put it on. I've hit my 200% rule. So I close it and I've lost whatever credit it was. Let's say I put on a credit of $1. So I brought in $100. When I close it for $2, I'm now $200. I paid $200, so that means I'm $100 in the hole. But I've got a put spread. Now, presumably the put spread that I sold was probably for a similar credit. And so what that means is that when I close either side with the 200% rule, I'm probably close to break even. And that's the power of this trade or this rule. Now, I've had students who have gone through extensive coaching and then decide that what they want to do is trade iron condors on one of the indices month after month. And I've had students that have started out like that and have used the 200% rule, and in 1 year, in their first year, have had a profit, even though they had a lot of trades closed. They might have had 8 trades closed throughout the year. But the point is they ended up with a profit because each time they were closing, they were doing it in time. They weren't letting this thing run over them, so to speak. So the point here I'm trying to make is that there's no free lunch here. The advantages of this type of trading are, number one, you can generate consistent monthly income. Number two, you've got a pretty good profitability advantage. You have a pretty good probability on your side. And generally speaking, you have a wide range of price where you're profitable. And I think there's actually figure out where this market's going, not having to worry about all these different technical indicators and so forth and so on. You just follow your rules. Just like I mentioned before, you've got your 200% rule, and that's what you use. And so you just trade what the market does today. Market moves today, you look at your spreads, you decide, oh, strip my rule, I'm closing that. Closing the whole thing, closing half of it, whatever it is. No sitting around hoping. No sitting around feeling greedy one day and changing something. You're just following your rules. Now, the disadvantages of this type of trading, of course, is that large loss that's lurking out there. Even though it has a low probability of happening, it's still there. And so you have to keep that in mind. And that's why you keep this in your head and you think, okay, this is a dangerous trade and I'm going to manage it like that. See, too often we put on a trade like this with a 90% probability of success, and we think to ourselves, oh, well, this is great. I can relax. No, 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 no. If anything, it should be just the opposite. What you should be thinking about is not the 90% probability of success. You should be thinking about what I would lose if I take the maximum loss, because that's the sobering thought. And that should get you to think about, how am I managing this trade? Risk management is key. Non-directional trading, there's a lot to be said for it, but you always have to keep those two thoughts in mind. Just because you have a high probability of success, that doesn't mean you're not going to have the months or the even several months where the market moves against you. I mean, for example, last year, if you, from roughly beginning of April to the end of 2020, you could almost throw rocks at the market and make money. It was just going straight up. If you were trading directionally. If you were trading non-directionally, you would be closing your spreads almost every month because the market just kept going higher. Now, if you were using a trading system, some kind of risk management system, where you close those spreads at a reasonable point in time, well, you might not have ended the year with a lot of money, a big profit, but you wouldn't have lost either. You would have had a small loss, or maybe even broke even, maybe had a small gain depending on what happened at the beginning of the year. But the point is, you have to have a risk management system for this type of trading. It actually has its advantages in terms of not having to predict, not having all that stress, but you've got to follow your rules and manage that risk. So if I've piqued your interest, you might want to learn more. I offer both private and group coaching sessions. Sometimes we have group courses that I start, particularly on, I guess the one that I've done more often is conservative income trading, where we're just focusing on the different types of trades that we can use just for conservative generation of income. Now, those typically are somewhat bullish to slightly bullish trades. So those are more like selling covered calls, selling naked puts, that kind of thing, as well as collars and some other trades. And then we also sometimes have full A to Z kind of option courses as well. So you have to just keep track of my website for what we have offered at a particular point in time. And of course, if you want or would like private coaching, we offer that as well. And I even do custom private coaching where you just want to study 2 or 3 topics or one topic, and we'll just have whatever number of classes seems appropriate for that. And so we just customize those. I have a weekly newsletter. It's $99 a month. This the newsletter basically is analysis of the market at any point in time. and then also has a recommended trade about once a month. The trading group is different. The trading group is like a continuing education group. We're always trading. We'll have 5 to 6 trades a month. But in my meetings, we have two webinars per month. And during the meetings, I go through all the trades that we put on and closed or whatever, and explain why did we do this? Why did I adjust it this way, etc. So this is the trading group is a very good continuing education group. A lot of my coaching students will sign up for the trading group and stay with me, so to speak. The conservative income trading service is just what it sounds like. It's just conservative trades. I send out the trades once a week or whatever I put them on, basically. Could be several times in a week. And then I manage them. I tell you when to close them, tell you when to adjust them. And we have one webinar a month where we talk about those trades and what candidates we've come up with to use for the next month. The Flying with a Condor is a trading service that focuses on the iron condor traded on the S&P 500 index. Here's my website address, my email, the office phone number. So if there's any other questions, I'll be glad to take those now.
Yes, thank you, Duke. And I just want to just leave this page up for a second. It's great that you have all of these listed here, because I'm actually going to show everyone where on Option Hotline they can go ahead and get more information about and subscribe to each one of these different products that you have. And just to reiterate, if anyone does have questions regarding the specific presentation that Duke just gave, please ask them now. Type them in the chat box or the Q&A box. We have a couple of minutes so he can go ahead and answer those live for you. I did get a question from some people, Duke, while you were speaking. You were talking about, obviously having a trading system and a good risk plan and sort of taking the guessing work out of it, right? And then you mentioned at the end how trading group, your product trading group, kind of does that for you. So I was hoping you could go into a little bit more detail about it. I hope everyone can see this screen. You can see, I'll put this link in the chat box as well, so you can just click the link and visit this exact page so that you can click through each of Duke's products that he mentioned. But I did want to talk a little bit more about trading groups, since it seems to pertain directly to what you presented this afternoon.
Okay, sure.
If you have any additional info you want to share, this is the page where, you can choose to subscribe. You choose an option, monthly or annual. And once you make that selection, you go ahead and continue on to the cart. And tomorrow, each of you should be receiving an email with the replay, as well as the free gift from Duke and a special coupon code for this product, specifically trading group. So yeah, Duke, if you don't mind giving just a tiny bit more info. That was a couple of different people asked me about that while you were presenting.
Sure. Now, the trading group it does a lot of different trades. It has some delta neutral trades, but I would say more of our trades are directional than non-directional. What the trading group tries to emphasize is learning about what we're doing and why, so that we become better traders in the process. And so a lot of those trades may be directional, may be bullish, may be bearish, may be sideways delta neutral trades, but it'll be a variety. The thing you're really getting in the trading group is the 2 webinars a month where we discuss those trades and talk specifically about why did we set it up the way we did, why did I choose those strike prices, why did I adjust it the way I did, why did I close when I did, whatever it might be. I try and go through detail so that you understand what we're learning from what we're doing. Now so
you're basically getting, they're getting actual trade alerts, and then you follow up and kind of explain why you sent those particular alerts, why you made the decisions you did. So
that's right. That's right. And I follow up and tell them when to close it or when to adjust it, whatever it is. The one service that I have that's purely non-directional, like we've talked about in this seminar, is the Flying with a Condor. Now that's a purely non-directional service. The Flying with a Condor is just the, as I mentioned before, you're selling a credit spread up above the S&P 500 and selling a put spread down below it. And we just do that every month. And Right now, I think this is the 14th month in succession that we've been profitable. So we
Ah,
have
fantastic.
pretty good batting average. But the point is, some months we may make 5 or 6 adjustments. I mean, especially lately, because you're usually trying to dodge the market just going higher and higher. So
Right. Well, great. Thank you for the additional detail on that. We have a question from Steve coming in. He asks, when your trading plan references sigma, standard deviation, does this need to be recalculated every day?
yes, it does. Because 2 things are changing. One is implied volatility is likely changing, and certainly the time to expiration is changing. So you really, it may not change much, but I think it's a good practice to do that. I actually on my website under free downloads, you'll find a probability calculator. It's an Excel spreadsheet, and so it makes it easy for you to do that.
Oh, great. Great. Thank you. Okay, excellent. We have about a minute or so left. I know we're pushing against the timeline. I did want to give everyone, if you have any last questions, go ahead and get those out now. Otherwise, I'll start just a brief kind of ending wrap-up tour for everyone, reminding you of the key points of the Option Hotline website. Obviously, you can see we're on Duke's page right now. I copied and pasted this link into the chat box. So please go ahead. I'll do it again, just in case you have it, and visit this page and really, look through all of his different products and feel free to see if any of his educational resources or trading resources would be a good fit for you. And Duke did put up his contact information directly, so please feel free to reach out to him. Alternatively, you can reach out to the team at Option Hotline. The emails would be for customer support at optionhotline.com. If you have questions regarding the webinars at optionhotline.com. And if you want additional information and just to talk to someone about Duke's products specifically, go ahead and reach out to the sales group we have here, info@marketeducation.net. or call them. They're at 312-858-9009, and they'd be happy to talk with you about Duke's products, in more detail on a time that's convenient for you. So one last reminder to mark this webinars page on your bookmark websites. Come check back, register for the up and coming webinars we have. We will have Duke back on here again. So please feel free to sign up and take advantage of the webinar replays that we post as well. You can go back. Starting tomorrow, you're going to see Duke's webinar replay right here. So you'll be able to rewatch and relearn and write down anything that you missed today. And finally, keep an eye out on your inboxes tomorrow from an email from webinars@optionhotline.com. That is going to contain your recorded replay link, your free giveaway from Duke, and a special coupon code for Dr. Duke's trading group, which he touched on this afternoon as well. So I think that was pretty much everything. Duke, thank you so much for coming on and giving us your time and your knowledge about these areas. And I want to thank everyone who took time out of their day to join us as well. We know everyone's busy, and we appreciate you taking the time to come learn with us. So thank you,
Natalie.
Everyone.
It was my pleasure.
It's my pleasure. Oh, well, there you go. Both of our pleasures to have everyone here. Thank you all. And yeah, check the webinars page. Come join us for the next one on May 26th. Duke will have you back on again soon, and I hope everyone stays happy and healthy. We'll see you all again next time. Thanks, everyone.